Today, we will reshape your mindset in 5 minutes and break down 12 investment lessons.
In 1969, the stock market was captivated by the Nifty 50. Investors viewed these companies as possessing flawless business models and perfect prospects, making them appear immune to market forces. Right in the middle of this market euphoria, a young analyst named Howard Marks started his career at First National City Bank. The institutional environment was driven by a single consensus. Managers operated under the mantra that buying shares of companies like IBM was a risk-free career move. No one could get fired for owning it. Because these were seen as the ultimate growth companies, the industry assumed their sheer scale and market dominance insulated them from any economic downturn. When the entire market agrees that an asset is perfectly safe, that uniformity of thought acts as a blinder. Investors become unable to see the risk that is hiding in plain sight. Then the 1973 OPEC oil embargo hit, a macroeconomic shock that the institutional models had entirely failed to account for. A cascading panic swept through the market. As the reality set in, the institutions that crowded into the same safe positions all tried to exit at the same time. The immediate damage was severe. Standard benchmarks like the S&P 500 dropped by 47% over the course of the crisis. But the Nifty 50 suffered an even worse fate. These perfect companies saw their valuations plummet, falling from peak price-to-earnings ratios of 90 down to single digits. The followers of these infallible companies lost almost all their money. If the assets deemed to be the safest can trigger total financial ruin, the traditional models we use to measure risk and return are broken. By 1990, Howard Marks was refining a different approach. He met for dinner with Dave, the head of the General Mills pension fund. Dave shared a specific metric about his performance. His fund had never ranked in the top quartile of its peers in any single calendar year. Yet, over that exact same 14-year period, Dave's fund had outperformed 96% of its competitors. He achieved this by ensuring the fund never fell into the bottom half of performers. He wasn't trying to win each year, he was trying to avoid losing. This requires the discipline to watch competitors temporarily surge ahead with risky bets, while you stay focused on baseline survival. Long-term outperformance is the result of structuring a portfolio to avoid devastating losses, rather than chasing high flyers. This is the standard risk equals return graph taught in academic finance. It presents a clean upward slope, where taking more risk leads to a higher return. But that straight line is a marketing illusion. It is the expected promise required to attract capital, not a guaranteed outcome. Marx replaces the points on that line with a probability distribution, a bell curve representing the range of possible results. Moving further right on the risk axis does raise the expected return, the center of the curve, but higher risk also widens the bandwidth of uncertainty. The range of possible outcomes grows significantly. As the curve stretches, its bottom tail plunges deeply below the zero line, moving into a zone of absolute, unrecoverable loss. Taking on more risk doesn't guarantee more profit. It guarantees a wider variance of outcomes and a higher probability of a total wipeout. The 1980s high-yield junk bond market was the perfect real-world testing ground for this theory. Marx targeted fallen angels, bonds from downgraded companies that still possessed fundamental assets to protect the downside. Instead of chasing the highest yield, he meticulously evaluated the worst-case scenarios to avoid defaults. Over decades, the high-yield bonds Marx invested in saw an annual default rate of 1.3%, while the broader market averaged 4%. Maximizing profit in a dangerous market is achieved by aggressively minimizing the left tail of that probability curve. Exceptional investing is a game of probability. Success comes from avoiding fatal losers, not from possessing a crystal ball to find winners. But the cost of this strategy is the pain of being a true contrarian. It requires buying what the crowd universally despises and refusing to buy what is comfortably popular. You have to endure profound psychological isolation. You have to stand still while the consensus rushes past you, even when staying still feels foolish. Do you actually possess the behavioral alpha required to endure the pain of contrarianism, or should you admit defeat and buy an index fund?